Do you know what's the greatest magical trick in finance? Think about this. You're at your favorite coffee shop. You order your usual. You tap your card. The screen says approved. The barista hands you your drink. You paid instantly, right? You think you just bought that coffee. The barista thinks you just bought that coffee. But the truth is, that money is not yours anymore. It's not even theirs yet. It is stuck in a digital limbo. What if I told you that the entire global financial system, worth trillions of dollars daily, is built on an illusion? A mass delusion where everyone pretends money moves instantly, when it actually crawls through a labyrinth designed before most people owned a computer. Behind that millisecond of convenience when your screen says approved hides a financial infrastructure so outdated it predates the internet. A system where banks and credit card companies quietly profit from the gap between what you see and what actually happens. And here's the kicker. This decades-old system is collapsing under its own weight. As transaction volumes surge and payment options multiply, big tech is invading finance. Real-time payments are becoming reality, and businesses caught using yesterday's financial tools to navigate tomorrow's economy, they're already becoming extinct. You pay, the company waits, and banks earn billions without saying a word. And that's the true greatest magical trick in finance. Welcome to the greatest financial revolution you've never noticed. Every day, billions of people experience the same mirage when they tap their card or click Pay Now. But you've been deceived by design. That approved message is just a digital IOU, while the actual money sits perfectly still. And you enjoy this paradox in every service. You can instantly stream high-definition video from across the planet, but your money, which is essentially just digital information, moves at the pace of a Nixon-era postal service. Most consumers have no idea that when they tap their card, they're initiating a complex process involving up to 7 different parties, each taking their cut for essentially moving data from one server to another. Let's break down what really happens in those few seconds after you tap. First, your card information travels to the merchant's payment terminal or payment gateway. Next, that information flows to a payment processor, who routes it to the appropriate card network. The card network then forwards your information to your bank, which verifies you have enough funds and that the transaction doesn't appear fraudulent. Your bank sends an approval message back through the entire chain to the merchant's terminal, all in seconds. But here's the critical distinction. That approval is just a promise. The actual money, it's still sitting in your account. The merchant has received permission to collect it, but not the funds themselves. Visa, MasterCard, American Express. These brands that symbolize speed and convenience actually operate on systems built when cassette tapes were cutting-edge technology. Each has different rules, time frames, and fee structures. At scale, this creates a nightmarish complexity that businesses must navigate, reconcile, and account for. Consider a clothing retailer that accepts credit cards, debit cards, PayPal, Apple Pay, and buy now, pay later options like Affirm or Klarna. Each of these payment methods settle at different times, generates different reports, and charges different fees. Some transactions might fail days after they initially appeared successful. Others might be disputed by customers weeks later. Credit card payments? 2 to 3 business days. ACH bank transfers? 1 to 3 business days. Paper checks? Up to 5 business days. Buy now, pay later services, often variable settlement schedules. PayPal and digital wallets, usually 1 to 2 business days. Meanwhile, the explosion of payment options from digital wallets to buy now, pay later services has only intensified the reconciliation challenge for businesses. Companies now manage more payment types than ever before, each with unique workflows, settlement timeframes, and reporting formats. Let's look deeper at what this means for businesses of all sizes. When you make a purchase, the merchant must track that promised payment, reconcile it with their inventory or service delivery, account for any fees taken by payment processors, and manually investigate any discrepancies, all while waiting for the actual money to arrive. So while you walk out with your coffee, that small business owner won't see that money hit their bank account until days later. They're left waiting, wondering, and often struggling with cash flow. Also, the payment industry can extract billions in fees from the float and processing charges. The float, that period where money exists in a kind of financial purgatory between accounts, generates massive revenue for banks and payment providers. They earn interest on funds in transit and collect fees at multiple points in the transaction chain. In 2023 alone, payment processing generated over $100 billion in revenue for financial services companies in the US. This delay isn't just an inconvenience. It's the foundation of a system where banks and card networks extract over $100 billion in fees annually, precisely because they control the pace of money movement. But why does this delay exist in the first place? Our payment infrastructure wasn't designed for today's digital economy. It was architected when physical checks needed to be transported and processed in batches, when computing power was measured in kilobytes rather than terabytes, and before global, instant communication was possible. The batch processing mentality, gathering transactions throughout the day and processing them together overnight, persists despite technological advancements that have transformed every other information system on the planet. In a world where you can video chat with someone on the other side of the planet in real time, where self-driving cars navigate complex city streets, where AI can generate art in seconds, why is your money stuck moving at the speed of a fax machine? The answer is as uncomfortable as the question, because the current system enormously benefits the middlemen who built it. But the truth is, money has never remained static. Throughout history, it has continuously evolved. From precious metals to paper currency, from handwritten checks to credit cards, from brick and mortar banks to online banking and mobile payments. Every major shift in how we use money has created winners and losers. Consider Blockbuster, which rejected an opportunity to purchase Netflix for $50 million in 2000. As Netflix embraced digital streaming, Blockbuster clung to its physical retail model until bankruptcy in 2010. Today, Netflix is worth billions, while Blockbuster exists as a single remaining store, a museum of failed adaptation. Today, we stand at another critical inflection point, perhaps the most significant one since the invention of electronic payments. Electronic payments have skyrocketed in recent years. Cash transactions, which represented 40% of all payments in 2010, dropped to under 20% by 2022. Meanwhile, digital payment volumes have more than doubled over the past decade. But unlike previous financial evolutions, which rolled out over decades, the current transformation is happening at internet speed, compressing what might have been a 30-year transition into just 5 years. This isn't just about convenience. It's about business survival. Now, let's look at what this means for businesses. Let's find out how your company handles its finances today, because this is the reality that keeps CFOs awake at night. According to a 2019 study developed by BlackLine and titled Mistrust in Numbers, 70% of business leaders admit they've made significant decisions based on inaccurate financial data. But the hard point is that only 38% of finance professionals actually trust the data they produce. Let that sink in. The very people responsible for creating financial reports don't believe their own numbers. For a typical mid-sized company, the month-end close is a chaotic scramble. Finance teams work late nights, manually downloading data from various systems, copying figures between spreadsheets, and hunting down discrepancies. When the people who understand these processes leave, they take irreplaceable knowledge with them. When a CFO can't trust the numbers in front of them, they're essentially flying blind. This crisis exists because our financial systems are fundamentally disconnected from the reality of modern commerce. While consumers experience the illusion of instant payments, businesses struggle with delayed settlements, complex reconciliation, and outdated financial workflows. Many companies still rely on manual processes and spreadsheets for financial closes, what industry insiders call tribal knowledge, where critical financial processes depend on undocumented expertise of specific employees. In many organizations, month-end close is still a chaotic, all-hands-on-deck scramble. Critical processes often reside only in the minds of longtime employees, creating dangerous dependencies and knowledge silos. When these employees retire or leave for other opportunities, they take irreplaceable institutional knowledge with them. Companies find themselves unable to reproduce essential financial reports or understand the assumptions behind key calculations. And these problems are only getting worse as transaction volumes increase, payment methods multiply, and business models grow more complex. The financial infrastructure that worked for a simpler time simply can't handle today's complexity. While traditional finance struggles with its legacy infrastructure, a new financial ecosystem is emerging, built for real-time money movement and powered by companies that didn't exist when the current system was designed. Let's look at the two forces reshaping finance simultaneously: new payment infrastructure and big tech's financial invasion. New payment networks like FedNow, real-time payments, and India's unified payments interface are making truly instant payments possible. These systems don't just create the illusion of instant approval, they actually move money from one account to another in seconds, 24/7, 365 days a year. The Federal Reserve launched FedNow in 2023, the first major upgrade to America's payment rails in over 4 decades. When fully adopted, it will collapse the 3-day settlement window into 3 seconds. The implications are profound. Businesses can receive payment immediately upon delivering goods or services. Suppliers can be paid instantly upon invoice approval, potentially unlocking early payment discounts. Employees don't have to wait for payday to access their earnings. But as these new rails are being built, big tech isn't waiting. It's fundamentally reinventing the financial landscape. Apple now offers payment processing, credit cards, and savings accounts, creating a closed financial system within its technology ecosystem. What started as a convenient way to pay has evolved into a comprehensive banking alternative that bypasses traditional financial institutions. The Apple Card, launched in 2019 in partnership with Goldman Sachs, was just the beginning. Apple has since expanded into buy now, pay later with Apple Pay Later, high-yield savings accounts, and person-to-person payments through Apple Cash. By controlling the flow of both goods and money, Amazon strengthens its grip on the entire commercial experience. Since launching its lending program in 2011, Amazon has provided billions in financing to small and medium-sized businesses selling on its platform. These loans leverage Amazon's unique visibility into seller performance data, information traditional banks simply don't have access to. The result is a financing system that operates with less friction and potentially lower risk than conventional business loans. Google, Meta, and other tech giants are similarly investing billions in payment systems and financial services, not just to generate new revenue streams, but to capture the valuable data and customer relationships that come with financial transactions. The financial power of these tech companies is staggering. Apple's market capitalization exceeds that of the 6 largest US banks combined. Amazon processes more consumer spending than most major credit card issuers. And unlike traditional financial institutions, these tech giants aren't burdened by legacy infrastructure or subject to the same regulatory requirements as banks. These tech giants understand something that many traditional businesses haven't yet grasped. Controlling the flow of money means controlling the customer relationship. While the transformation accelerates, the volume and complexity of financial data are exploding exponentially. More payment methods, more channels, more transactions, more global commerce, all generating a tsunami of information that outdated systems simply cannot process effectively. This is where artificial intelligence and automation become essential, not optional. We're moving from periodic financial reporting to continuous financial intelligence. It's the difference between getting a snapshot of your business once a month versus having a real-time dashboard that updates with every transaction. The businesses that thrive will be those that make this transition rapidly. Those that don't risk making critical decisions with outdated information, while their competitors operate with real-time precision. This brings us to the painful reality many businesses are facing. Failure to modernize financial operations isn't just costly, it's potentially fatal. Let's make this tangible with a real-world scenario. Imagine a growing retail chain with 50 locations. They're using traditional financial systems and manual processes. Here's what their financial reality looks like. First, cash flow constraints. With a traditional 2 to 3 day settlement window, they constantly have $300,000 to $500,000 trapped in the payment system rather than working for their business. This limits their ability to open new locations, negotiate better terms with suppliers, or invest in growth opportunities. Second, excessive fees. They're paying 2 to 3% on every credit card transaction, amounting to hundreds of thousands in annual processing costs that cut directly into their profits. Competitors using newer systems are paying a fraction of these fees. Third, Decision paralysis. Their monthly close process takes 10 to 15 days, meaning executives are making decisions based on information that's already 2 weeks old. By the time they identify a problem in one location, weeks have passed and the issue has already impacted the bottom line. Fourth, error-prone reporting. With manually maintained spreadsheets, they've experienced critical errors in their financial statements. Last quarter, they discovered their inventory was overvalued by 15% due to a formula error, forcing them to restate earnings and eroding investor confidence. In one notable example, a major retailer invested millions in international expansion based on spreadsheet models that contained fundamental formula errors, significantly overstating potential profits. By the time the error was discovered, the company had already signed leases and hired staff for locations that would never be profitable. When financial errors accumulate, businesses sometimes need to restate their earnings, sending a troubling signal to markets and investors. These errors create growing mistrust between executive teams and finance departments, generating internal tension and uncertainty. As one CFO put it, if you can't trust your numbers, you can't trust your strategy. Finally, talent drain. Their finance team is burned out from manual reconciliation and extended month-end closes. Top performers are leaving for competitors that offer more strategic roles and modern tools. Most businesses today manage reconciliation primarily through Excel and undocumented tribal knowledge, where crucial financial processes depend on the institutional memory of specific employees, rather than systematic documented procedures. Finance teams frequently work nights and weekends during month-end close, manually extracting data from various systems and struggling to reconcile discrepancies. This not only creates a poor work environment and increases burnout, but also makes the finance function a bottleneck rather than a strategic enabler. This isn't a hypothetical scenario. It's the reality for thousands of businesses today. And in a business environment where margins are thinning and competition is intensifying, these inefficiencies aren't just inconvenient, they're existential threats. The most dangerous position for a business today is being caught between two worlds, selling to customers in a digital economy while managing finances with industrial-age tools. While many businesses struggle with financial transformation, forward-thinking companies are already reshaping the future of money movement and financial operations. Let's look at two critical strategies emerging among financial innovators. First, embracing new payment paradigms. Companies are rethinking how money moves through their business by leveraging technologies like real-time payments. Consider Uber's implementation of instant payouts for drivers. By allowing drivers to access their earnings immediately rather than waiting for weekly payments, Uber created a significant competitive advantage in recruiting and retaining drivers. Before Uber's instant pay feature, gig workers typically waited days or even weeks to access their earnings. This created significant hardship for many drivers, who often live paycheck to paycheck and need immediate access to their income for daily expenses. When Uber introduced Instant Pay in 2016, it fundamentally changed expectations in the gig economy. Drivers could cash out up to 5 times per day, receiving their earnings within minutes, rather than waiting for weekly payments. This seemingly simple feature had profound implications for driver loyalty and platform competition. When Uber launched Instant Pay, competitor platforms lost drivers almost overnight. In the gig economy, where workers often live paycheck to paycheck, waiting days for your money is no longer acceptable. Second, companies are transforming their internal financial operations through automation. Forward-thinking businesses are implementing platforms like BlackLine that automate the financial close process, reduce errors, improve confidence in financial data, and enable finance teams to transition from report production to strategic advisory roles. These automation platforms connect directly to source systems, continuously importing and reconciling transaction data, instead of waiting until month-end to identify discrepancies. Automated systems flag potential issues in real time, allowing for immediate investigation and resolution. The vision is moving toward continuous accounting rather than periodic closes, where systems are constantly connected to business transactions, automatically detecting anomalies and adjusting reports in real time. The results? are transformative. One company reduced its month-end close time from 10 days to just 3 after implementing automation. Another decreased manual journal entries by 85%, freeing finance staff for more strategic work. A third eliminated over 20,000 hours of manual reconciliation work annually, time that could now be invested in financial analysis and business partnering. These success stories illuminate a critical truth. Financial transformation isn't just about keeping up. It's about unlocking entirely new possibilities for business growth, customer experience, and strategic advantage that simply didn't exist before. The financial transformation we're witnessing isn't just about technology. It's about business survival in an accelerating world. Real-time payments and financial automation are no longer optional luxuries. They're essential capabilities for remaining competitive. As payment systems evolve and financial data grows more complex, the gap between companies that adapt and those that don't will widen dramatically. Businesses that embrace this change will enjoy significant advantages: better cash flow management, reduced processing costs, more accurate financial data, and the ability to make faster, more informed decisions based on real-time insights. Those that resist will find themselves increasingly constrained by delayed access to funds, high transaction costs, and strategic decisions based on outdated or inaccurate information. Today's most successful companies are approaching finance with a new mindset, replacing batch processing with continuous monitoring, manual reconciliation with intelligent automation, and periodic reporting with real-time insights. Finance isn't just a back-office function concerned only with compliance and audits. It's the essential foundation of all business intelligence. When your financial data is accurate, timely, and accessible, every decision becomes more informed, and every strategy more effective. The illusion of instant payments is giving way to the reality of real-time finance. The businesses that thrive will be those that recognize this shift and position themselves to capitalize on it, not just by adapting to changing payment systems, but by fundamentally transforming how they manage their financial operations. The future of finance isn't coming. It's already here. The only question is whether your business will lead the change or be left behind by it.